Hey everybody, I'm Jason Bronchetti, back with another look at 3 key themes on the minds of investors using visuals from our Market Intel Exchange. To start, the Federal Reserve kicked off the highly anticipated rate cutting cycle with a decisive 50 basis point reduction in September. And with more cuts to come, investors are beginning to turn their attention to what this shift in monetary policy could mean for their portfolios. So let's take a look at some historical context. The first takeaway here, especially given the more than $6 trillion sitting in money market funds, is that cash yields tend to fall quickly following the start of cutting cycles. In fact, since 1974, they fell on average by 2% within just 12 months of the initial cut. This erosion of yield could be a catalyst for some of the cash to begin moving off the sidelines and into equity markets, where history shows a bit of a mixed story in the immediate aftermath of rate cuts. On average, U.S. stocks have generated a modest positive return following the start of cutting cycles, rising just over 7% in the first year. However, there's much more to the story, and the why behind the easing of policy has historically been the most impactful variable driving asset prices. Are officials acting due to positive signs like falling inflation, or negative signs like a deterioration in labor markets and economic instability? In those cycles where the economy avoided a recession within 1 year of the first cut, we found that stocks rose nearly 20% on average. However, when the economy was either already in or entered a recession within 12 months of the initial cut, results were starkly different, with stocks losing nearly 3% on average. It's too early to say which group this 2024 cycle will fall into, but the picture today is that of a slowing but still growing economy without clear signs that a recession is imminent. Though, of course, as we've seen in the past, this can change quickly. But regardless of where the economy lands, long-term investors shouldn't be deterred from confidently staying the course. Because when we zoom out, the numbers also show that 5 years after the start of cutting cycles, stocks were higher every time, with an average gain of almost 80% overall and nearly 60% even in those instances that coincided with a recession. Among many other things, presidential elections bring no shortage of uncertainty about the future, which just happens to be the one thing that market participants dislike the most. So it's likely no surprise that looking back at previous election years, on average, equity market volatility has increased in the months leading up to and including November, especially relative to years without an election. The good news for investors, though, is that this tends to be short-lived, as turbulence has subsided quickly once the results are in, and to some extent, that cloud of uncertainty was lifted. This same trend can be seen when looking at returns. The bottom visual shows the average one-year return of the S&P 500 beginning in July of election years. In the dark blue section of the line, which represents the period up to election day, we can see that volatility shows itself in the choppy price movement throughout September and October. However, after Americans have gone to the polls, those who weathered the uncertainty were rewarded with strong average gains. Not only in the short term, as pictured here in the more than 16% gain from election day through the following June, but also over the long term. On average, an investment in the S&P 500 made at the start of November in election years grew by more than 11% annually over the next decade, regardless of which party won. A takeaway for investors is that if history is any indication, we should be prepared for the possibility of higher volatility in the coming weeks and months. However, those that stay the course are likely to be rewarded because over the long term, history shows that while people care about politics, markets don't. Volatility is a feature of investing, not a defect. However, many investors instinctively view it as something to fear and avoid, which far too often leads to poor behavior and subpar long-term results. With that in mind, we put together some information to help evolve the mindset of investors and encourage them to view volatility through a new lens, as a friend rather than a foe. Using the daily closing prices of the VIX, which, while often referred to as the fear index, is a real-time measure of expected near-term volatility of the S&P 500, we found that an investment made on any day had a solid average return just shy of 10% over the next year. However, an investment made on days where the fear index closed at elevated levels performed significantly better, rising upwards of 25% or more over the next 12 months. Given this dynamic, we feel most investors could benefit from thinking of the VIX as less of a fear index and more of an opportunity index. Because while it's always a good time to invest, history shows that some of the best opportunities have come during periods associated with rising volatility and unease in the markets. This represents a powerful context for those investors who tend to feel a bit nervous about the prospect of market volatility. By viewing volatility through a new lens, it can encourage them to stay the course, or perhaps even better, capitalize on the opportunity that it tends to provide to put additional assets to work for the long term. So there you have it, 3 key themes on the minds of investors. For more information and to access a comprehensive set of client-approved slides on both the markets and the economy, I encourage you to check out the latest edition of Lincoln's Market Intel Exchange. Thanks for watching.